Welcome back to The Explainer. Today, we're zeroing in on a genuinely massive moment for one of the biggest names in tech. We're talking about Salesforce, and specifically, we are gearing up for their upcoming August 26th earnings report. This is literally shaping up to be one of the most pivotal moments for the cloud giant in recent memory. Right now, the stock is sitting at this fascinating crossroads, trading somewhere between $190 and $196. And honestly, the setup here is so incredibly unusual, which is exactly why we need to unpack the whole shebang today. Because here is the million-dollar mystery we are trying to solve. Why is a historic market darling getting punished? Think about it. This is a cloud software giant that consistently beats earnings estimates. Yet the stock is down roughly 28% year-to-date and almost 30% from its 52-week high. I mean, why does a company that seemingly does everything right on paper just keep getting hammered by Wall Street? Well, it's a bit like a tug of war. The market is currently pricing in total stagnation, while management is out there loudly promising a massive reacceleration. And look, both of those narratives just can't be right. Okay, let's dive into this with Section 1, the valuation bull case, cash flow, and value. To really grasp the bull case, we have to start by looking at the heavy-hitting positive metrics that have investors so fired up about this $42.8 billion revenue business. Simply put, Salesforce is an absolute cash machine. They're generating a free cash flow yield equal to 8.8% of their market value every single year. To put that into perspective, that is exactly double the 4.3% median for the S&P 500. On top of that, their operating margin sits at a fantastic 22%, which comfortably beats their 3-year average of 20%. They are producing cash at a staggering rate, and if you're an investor looking for stability, this is a massive green flag. And when you take all that cash and look at the actual valuation, things get even more interesting. Salesforce has a forward price-to-earnings ratio of just 13.2x. That is way below the enterprise software sector average. Plus, take a look at that PEG ratio of approximately 0.57. That puts Salesforce squarely in deep value territory. It's wild. The market is pricing these deep value numbers as if the company is completely flatlining, even though top-line revenue is actually still growing at around 11%. And that massive disconnect is exactly why we arrive at this number right here, $243. That's the average fair value estimate from Analyst right now. Actually, some fair value estimates even reach as high as $282. So we're talking about an implied potential upside of anywhere from 23% to 48% from current trading levels. So you might be wondering, if the numbers look this good, what exactly is the catalyst that's supposed to drive all that future growth? Well, that brings us to Section 2, Agentforce Momentum, the AI engine. Management's core argument for this big reacceleration relies entirely on their AI engine. The whole narrative is shifting here, from traditional software to the future of artificial intelligence. Salesforce has leaned incredibly hard into Agentforce, and the absolute crucial point to remember is that this is no longer some pilot program or a fun beta test. No, Agentforce now represents an annual recurring revenue stream greater than $1 billion. It is a massive, highly tangible part of the business. And this isn't just internal marketing hype either. Channel checks from Citi have shown that Agentforce deployments are genuinely gaining traction out in the real world, providing some serious pricing tailwinds. Now, what's really interesting about this slide is the sheer scale of the adoption. In its latest quarter, Salesforce processed a mind-blowing 28.6 trillion tokens. That's an increase of 152% from just the prior quarter alone. The usage metrics are absolutely exploding. Customers aren't just buying access to AI to say they have it, they are actively putting it to work at an immense scale. Which leads us perfectly to management's boldest claim. They've explicitly forecast that their AI and data products will, quote, drive organic revenue reacceleration in the second half of FY27. They are literally drawing a line in the sand here. Now contrast that bold statement against their full FY27 revenue guidance, which is sitting between $45.9 billion and $46.2 billion, representing about an 11% year-over-year increase. Management is essentially telling us, look, the first half is just setting the stage, but the AI engine is going to physically speed up the entire company's growth in the second half. But let's move on to Section 3, the earnings beat paradox, what to expect. Because despite all this incredible AI momentum we just talked about, we have to address a really strange phenomenon happening with this stock. And this brilliantly illustrates what I mean. Look at the data for Q1 of FY27. The consensus estimate for earnings per share was $3.13. Salesforce came in at a phenomenal $3.88. That is a massive 24% earnings beat. In fact, over the last 4 quarters, they've consistently beaten EPS estimates by anywhere from 5 to 25%. And yet, How did the market react to this blowout 24% beat? The stock bizarrely dropped 1.62%. No way, right? The market is literally refusing to reward these historical earnings beats. So moving forward, let's see how this sets up our expectations for Q2. Analysts are currently looking for roughly $11.32 billion in revenue and $3.28 in EPS. Interestingly enough, management's own guidance was actually a hair lower, calling for 11.27 to 11.35 billion in revenue and about $3.28 in EPS. But as we literally just established, simply beating these numbers might not actually be enough to move the needle for the stock. So if AI adoption is strong, why aren't contract bookings outperforming guidance? This right here is the elephant in the room. This rhetorical question is exactly what the skeptics are shouting from the rooftops. Impressive AI adoption and token processing just haven't yet fully translated into overwhelming financial strength, where it matters most to forward-looking investors. For 2 straight quarters now, contract bookings have failed to meaningfully outperform guidance. The market wants to see actual future demand, not just efficiency and current earnings. And that segues perfectly into Section 4, the bear case, execution risks. Acting strictly as an impartial referee here, we have to objectively lay out the vulnerabilities threatening this stock right now. First and foremost, we have execution uncertainty. On August 6th, President Srini Tallapragada stepped down after 14 years with the company. He was absolutely central to the development of Agentforce. Now, Rohan Kumar, an executive from Microsoft, has stepped in to take over. Look, having a major leadership transition concerning your most critical growth engine just weeks before a pivotal earnings call, that injects a really high level of uncertainty into their whole AI strategy. And beyond the leadership change, there are a few other cracks in the foundation. Channel checks indicate that older segments, like Tableau and Marketing Cloud, remain pretty weak, and renewals are increasingly contentious. Crucially, there's just very little net new customer demand showing up right now. UBS recently highlighted this, noting some mixed customer feedback. They actually see a higher likelihood that Salesforce might need to downgrade its reacceleration expectations, and they're maintaining a neutral rating with a $210 target. All this feeds into the fear that Salesforce might just be a value trap, that these flashy AI growth drivers just aren't strong enough to carry the older, dragging segments of the entire business. Now, when you zoom out and look at the broader street view from S&P Global, the consensus is what I'd call cautiously optimistic. You've got 33 strong buys and 6 buys, offset by 12 holds. JPMorgan is keeping the faith with a bullish $250 target, and Piper Sandler is holding at $215. But you also have more conservative voices in the mix, like Wells Fargo sticking with a $205 target and a hold rating. So the analysts are definitely leaning positive, but you know they are watching this upcoming report with a magnifying glass. Let's bring it all home with Section 5, the ultimate verdict, the final test. So what is it going to be? We've seen the incredible cash generation, and we've also seen the very real structural risks. The stakes for this August 26 showdown literally could not be higher. On one side of the ring, the bulls see a cash gusher marked down to a deep value 13x PE with AI momentum that's just beginning to truly scale. On the other side, the bears see a stock where massive EPS beats are completely ignored, older core clouds are weakening, and a sudden leadership change has kind of scrambled the AI narrative. The market is pricing in continued deceleration, while management promises reacceleration. Like we said earlier, they cannot both be right. So the absolutely crucial point is knowing exactly what to look for on August 26th. For us to see a substantial re-rating of this stock, Salesforce has to show a real inflection in subscription growth. We need to see that Agentforce ARR is expanding meaningfully, and critically, current remaining performance obligations, or CRPO, needs to sustain growth greater than 13% in constant currency. If they hit those marks, the bulls win this round. But if they falter on those specific metrics, the skeptics are instantly validated. Is this a value trap or an AI goldmine? That is the single most important question you should take away from this explainer today. The technicals perfectly mirror this exact conflict. We're seeing daily and weekly buy signals clashing right up against a longer-term monthly strong sell trend. The tension is incredibly palpable. Are we looking at a mature software company slowly losing its edge, or an undervalued AI powerhouse that's about to hit its second wind? August 26 will give us the answer. Thanks so much for tuning in, and make sure you keep your eyes peeled for those earnings.